We have seen a lot of activity recently around client money. Now, firms know that they must look after their clients' money properly, but there's also a big reputational risk here. The regulator now has a client assets unit, some 40 strong, and has levied 50 million of fines against firms and taken enforcement against 11 individuals. Last August, the regulator issued a consultation paper on the client money rules for insurance intermediaries. This is designed to increase the standard of protection and also make the rules clearer. Current systems and controls are basically going to have to be operated more frequently. For example, most brokers operate a non-statutory client money trust. For this, client money calculations will have to be carried out at least every 7 business days, rather than the current 25 business days. The external reconciliation to bank will also have to follow within 2 business days, rather than 10 at the moment. There are also some really important other changes proposed. For example, funding is not just a big commercial risk for brokers, but also a risk to client monies too. The new proposals mean that for funding purposes, brokers will only be allowed to offer a maximum credit of 45 days for clients and 90 days for insurers. They'll have to follow this up with a weekly funding review and top up where these limits are exceeded. Moreover, brokers are going to have to get much better at processing and recording transactions. Brokers are also going to have to be better at matching client monies to clients or transactions and do this within 90 days or return the money. Those using the accruals method for their client money calculation are also going to have to reconcile annually down to individual client level, covering at least 95% of the monies held. Credit write-backs are also being phased out. Pre-regulation balances will need to be resolved within a 13-month window after the new rules come into effect. Monies will only be able to be written back where the beneficiary explicitly refuses to accept payment, or where the beneficiary can't be identified. Otherwise, and after this window closes, any unclaimed monies will have to be paid to registered charities. The proposals will also introduce a cash resolution pack. This basically gives all the key information, records and reconciliations that an insolvency practitioner will need to hit the ground running. The big change is that the proposals are aiming to make it better for clients by not moving straight away to distribution of monies. Reasonable endeavours will have to be made to complete open insurance transactions. After this, there's the option to transfer all or part of the insurance broking activities to another firm along with the relevant client monies. Of course, there are many changes, and it's clear that brokers must get to grips with them. The proposed changes in the rules will mean really big changes to systems, processes and IT at many brokers. If a broker has lots of manual intervention in its processes, for example within the client money calculations, then it's going to take a significant amount of effort to get ready. The first step that a broker should take is to conduct a gap analysis. Brokers will need to put the effort in to fully understand their systems, processes and particularly the data sources from which they're working. Brokers should also have a credit write-back policy. They should begin to understand where the unmatched credits, and let's not forget the unmatched debits, are in their ledger. IT techniques can really bring efficiencies in doing this. And let's not forget, the cash resolution pack will also take a lot of time and effort to collate the data and prepare for. These proposals clearly mean significant change for brokers. As ever, it's always a sensible step to get outside advice and assistance when meeting big challenges.